Hey guys and girls, it's Nathan here from the B.Invested headquarters. Today I want to talk a little bit about some of the foolish things that people make when it comes to acquiring property, financing property, and making property deals happen. Looking at it, whether it be your first property, your 10th property, or your 100th property, it all comes down to financing to make sure you get that, because it doesn't matter how great the deal is, if you don't have the money, you don't have the funds, you don't have the aspect to purchase it, then it doesn't, you won't be able to purchase that property and acquire it. So some of the things are out there. I've seen hurt investors over the last 10 years of business, being a part of over 10,000 real estate transactions. I've seen a lot of things where people have made boo-boos, and generally a lot of it comes to financing, and it not necessarily need to be the purchaser or the investor's problem, but it's sometimes the broker, sometimes the investor. And probably the biggest one that I've seen people fall over on is the interest rates. They look at what's the cheapest interest rate that they can get in the marketplace and want to be able to purchase upon that. For myself, I've paid up to 30% interest rate, and not that that's good. I have had to pay that once because I wanted to make the deal happen. And I think about it a lot, where people come in, they go, I want to get the cheapest. I want 3.95, I don't want to pay 4.05 or whatever. They're looking at a couple of basis points difference on an acquisition where, it could be relatively like $10 or $5 per week, where, you could be saving, but they're not looking at the other aspect of it. So that's what I want to sort of focus on for a little bit here. I look at it from when I acquire a property, is that the $5 that I'm going to be saving, or the $10 that I'm going to be saving, or is it going to be the $100 that I'm going to be picking up, or the $50,000? For me, it's about the equity, the capital growth, and the asset accumulation, and what I can do with the deal. For me personally today, I pay interest rates anywhere from high 3% to about 7.5% as my highest interest rate. And for me, do I wish I could have them all at 3%? Of course I would, but does that stop me from buying the properties? No, because I'm an investor. I accumulate assets, I build wealth, and I focus on my cash flow. If you're paying the difference between an interest rate of $5 or $10, you are acquiring an asset where you can actually push up the rental return to offset that. So there's lots of factors when it comes to it, but ultimately, if you get the wrong product, or you focus on just the interest rate, and you're leaving yourself at risk of not being able to refinance that property, not being able to pull out the equity, not being able to service later, or getting yourself stuck into a pickle, which is going to ultimately stop your growth and stop your acquisition. In Australia, having 20,000 investors, less than 20,000 investors that own 6 or more properties, and us here at B.Invested being able to help those people acquire them, a lot of it comes down to that finance strategy and the actual accumulation strategy and the management strategy. There's 3 strategies that are attached to that, and the financing of it is really, really important to make sure you get that right, because if you don't, it's very hard to go back and fix it up and remedy it later. Looking at some of the other aspects of where people get hurt on, using lender's mortgage insurance. They think that it's better to put smaller deposits down on the property. Sometimes that can hurt you moving forward, because you don't have the ability to take that property and take it to another bank. Sometimes people get focused on buying a negative geared property, which the banks are looking severely negative on that as a strategy. And I think it's important that people understand, actually take an interest to understand, or have a finance strategist that actually does understand how to actually overcome all the hurdles that one investor would face on their journey. So another area where I see people get stuck is being loyal to a bank. Being loyal to the bank. The banksters are crooks out there, guys. Don't you realize that? But they can help you along your journey of acquiring wealth and accumulation of assets and whatnot. So where is the loyalty? People sit there and go, oh, I want to specifically be with this bank because my family's dealt with the bank. I've had a little specific money box when I was a kid, whether it be a Combank one or a St. George Dragon or whatever bank that you were dealing with as a kid. A lot of people actually get fixated and go, I can only use that bank. And the reality of it is that at different stages, different lenders will come and go. But as a successful investor, I first started off by going to the bank that I used as a kid, and they only helped me buy the first 1 or 2 properties, and then I had to go to further banks. So I've used pretty much all the big 4 banks, used lots and lots of banks over the years. There's probably been 20 different lenders that I've had that I've borrowed from. And I look at them just like a vehicle, like you need a different vehicle. If you were to travel from one place to another. You may not just have a plane that lands to where your destination is and pick you up from where you are. You need to catch an Uber, a bus, a train, push bike, a skateboard, an aeroplane, a helicopter, a bus, a coach, a boat, whatever the thing may be. You need different vehicles at different times along the way, and being a successful investor, you need to look at different financing strategies, different ways to be able to attain finance, and it may not just be your traditional lending model out there. It may not be your big four banks, may not be your second tier lenders, may even be a third tier lender, but if the deal's good enough, you should be open to looking to find a way to make that happen. I think a lot of people become too close-minded because they think, I've got to go back to Combank, or I've got to go back to Westpac, or I've got to go back to ANZ, or whoever the bank is that you've been using forever. Work with whoever's going to be able to lend you to support your goals. Having clarity on your goals, the bigger your portfolio gets, the more you treat it like a business. It's easier for you to explain to lenders, to banks, to brokers and whatnot, to be able to show them what you're trying to do, and for them to be able to get on board with your goals to help you finance those goals as well. So having an understanding of where the banks are at is very important as well. Some of the other things is cross-collateralization. So a lot of people out there think it's okay to cross. Some people just don't even realize that the loans are being crossed. It's important to understand what products are out there and make sure that you're avoiding the ones that are a little bit untoward and against your benefit. So for example, cross-collateralization is not for the borrower's benefit, it's for the bank and the broker's benefit to have cross-collateralized, because then they have greater control over your asset position and gives you less flexibility in order to be able to refinance, to sell off, etc. I've seen people that have sold a property and all the funds, they might be getting an extra $300,000, $400,000 worth of funds to pay for medical expenses, to pay for another purchase, to pay for whatever. But when they actually go to sell the property, all the funds get gobbled away because it was cross-collateralized. For me personally, none of my properties are cross-collateralized, and here at Zinger Finance, none of my financial team have ever cross-collateralized any of our clients' properties either in their portfolios. And I think it's important to understand that your bank isn't doing that to you, because it can sometimes be worded in a specific way in the loan contracts and could get investors stuck or homeowners stuck. The final thing is looking at fixed interest rates. And a lot of people get scared that interest rates are going to go up. Interest rates, can be cheaper by doing it, or whatever the case may be. What you need to understand is that when you're fixing an interest rate, you're taking a bet against the bank. The bank have a lot of people that are involved, a lot of money that's involved, and a lot of things at stake to make those bets against you. So to think that you're getting a better deal by fixing interest rates may or may not be beneficial to your position. And I think it's important to look at what the risks are that are associated if you do fix the interest rates and you need to get out. So if you fix the interest rates, looking at it at the moment, this is the first time in history, as we sit here in 2019, that interest rates have been cheaper to fix than the actual variable rates, and it hasn't been like that for any time that I've seen of foreseeable times. And for me personally, I think it's because we're going to see interest rates decrease over the course of 2019 and 2020. And if you were to fix the interest rates, it could be that they're cheaper today, and let's assume that's the case. I have fixed some of my interest rates as well, because I made a conscious decision and an educated calculation that I would be better off by doing so. But if I was to sell those properties and the interest rates were to be lower than the cash rate that's being charged to you, you will have to pay a thing called a break cost fee. And that could come if you wanted to refinance for equity, if you wanted to sell the property off, if you wanted to cash in the loan, etc. That is something there that would hurt an investor from being able to move forward. Some of the break cost fees that I've seen over the years have been in excess of $20,000. They've been as low as a couple of $1,000s and over $20,000. And that's something that as an investor, $20,000, that could be a half a deposit for your next acquisition. So when it comes to financing your next investment property, acquisition, or refinancing property, make sure that you're protecting yourself, that you have a full understanding of what your decisions are going to cause as the end result. And if you need any help, of course, you can call the office 1300-367-925, and one of my team, one of my finance strategists can help point you in the right direction. We'll catch up soon. Have a good day. Bye for now.